Okay, I wanted to show an example of a bearish move using price patterns. This company, Bilgari Holdings, I ran across it. I like to keep track of stocks that are over $100 a share because I just think that they move better. And the stock seems to have stalled out. And there's a couple of things I kind of want to point out real quick. If you take a look over here, we talked about in the beginning about the importance of higher highs and higher lows and how they signify a bull market. Well, then lower highs and lower lows also signify a bearish market or a bearish move. And so if you take a look here where I'm kind of highlighting some of the lows and the highs that are on the chart, you can kind of tell where price action is starting to weaken. And once it starts getting below these two main moving averages, which are the 50-day and the 200-day moving averages, those are followed really closely by institutions. And so once a stock starts firming up and trading above it, it gets the attention of the bulls, and once it starts trading below it, well, then it gets the attention of the bears. And people either start selling off their positions or they start shorting the stock. Now, if you take a look here, you can kind of see where I've highlighted it, and stock makes a peak high here, goes on to make a low, does the same thing here, can't quite get above the previous high, and it just starts trading apart. Well, as the stock starts moving into a period of contraction, it's transitioning. And you can start to see a price pattern form up here. Now, right here is where you're starting to find support. The stock is trying to hang on. The bears are trying to the bulls are trying to hang on. But the bulls' power, their control, is starting to weaken. Now, everything kind of starts reaching a period of critical mass right here. And the bulls tried one more time to kind of get a rally. And they just couldn't pull it off. So this is where you start watching volume. So if you start coming down here and you start seeing volume, it's kind of average. You know, maybe it's having a few bearish days here. It's experiencing some distribution. And then all of a sudden, boom, right here. And in addition to the price and the volume, or the surge in volume with price, you start to see a huge gap in price right here, which is an explosive move to the downside. This confirms the triangle pattern, this descending triangle pattern that you're starting to see here, and it falls apart. Now, one other little tip I want to give you for those who are going to short, and let me tell you, if you're a beginner with limited experience, I really don't recommend shorting the market. It is a professional's game. I've been doing this a long time. I don't like to short the market, and if I do, I usually do it with put options, and that's a different subject for a different time. But when you start to see price go below the 200-day moving average, that's a significant change. This right here is called the death cross. When you start seeing the 50-day cross below the 200-day moving average, and especially when you start seeing it start to slope downward, that's called the death cross. That means that whatever control the bulls had up here, it's gone through a period of transition, and now it belongs to the bears. And so price is telling us a story. It's telling us that there's a changing of the baton. You know, it's like a change of presidential administration. It's a transfer of power. And the bulls tried one more time to stage a coup to try to get it above the 200-day and just failed, and failed miserably. If you see a bullish move like this, or any move, a sharp spike up, and then it just immediately goes the other way like this, that's a huge counter trend signal. So this is how you use price action along with moving averages, and you use price patterns to kind of tell the tale of what's going on, and then you see moves like this, and then you take advantage of it. Got it? Good. Alright, good trading. I'll see you in the next video.